It doesn't matter whether you raise it at a $200 million or $220 million or $300 million valuation. It's the capital you need to grow. In the world I grew up in venture, almost having the IPO, ringing the bell on the New York Stock Exchange was almost the reason you formed a company. That was the victory lap.
When you were building SharesPost, who was your customer? How are you scaling the business?
The strategy we pursued was...
You sold the company for $160 million to Forge Global. Why did you sell your company?
For most founders, if you were to ask them, would you invest all your money in this company no matter how promising? Would you invest all your money in a single company? And nobody in their right mind would say yes.
Hey everyone, welcome back to $100 Million Exits. Today we have Greg Brogger on with us, currently founder and CEO of Collective Liquidity, but former founder and CEO of SharesPost, who sold for $160 million to Forge Global. Greg, welcome to the show.
Thank you. Good to be here, Jason. Thank you.
So Greg, I want to start just on that point. You sold the company for $160 million to Forge Global, which in my eyes, adjacency, or a competitor in the space. I want to know kind of why did you sell your company? What was going through your mind, and we'll kind of work backwards from there in terms of how you got there.
Sure. Well, there was a few things, or at least a couple things that were going on at the time that led to the decision to sell to Forge. And one was we were just coming to market to do our next round of financing in a kind of a typical venture wrapper, sort of, I think it would have been our Series D, something like that, Series C, when COVID happened. And so there was a period when the markets were in free fall. There was not a lot of investment happening. People were stepping back, so that gave us sort of pause. And then the secondary markets were also slowed to a crawl. And so we've been kind of marching and increasing our revenue steadily upwards, but we were looking at a quarter where there were going to be significant challenges because just no business was getting done during the call it the scariest part of COVID. It was we were looking for alternatives to financing and thinking that through. And at the same time, and maybe I could call it maybe the bigger reason, because I think we could have solved that problem. I'd been running the company for more than a decade at that point, and had felt I had kind of taken the broker-dealer model as far as I could. I couldn't really see a way to improve upon what we were already doing. I think from when we started the company in 2009, the broker-dealer model was the right fit, right? In a completely a market you're trying to start from zero. The simplest models for liquidity are the ones that make the most sense. So, hire a broker, match buyer, seller, sell shares, take a commission. That made sense, and that allowed us to kind of build, ultimately to doing $10 billion worth of total transaction volume in the time that I was there. But as the market deepened and developed in the sort of astronomical, meteoric rise of the number of unicorns and their total value, things started to change. So things that maybe weren't possible when there were only 2 or 3 companies trading, became possible when there's a lot more data providers and the market was much deeper. It seemed like maybe there was I won't even say better, but maybe a different way to solve some of the problems than just kind of a brokered stock sale. So it felt, I guess those are sort of the 3 reasons. One, the markets were in turmoil, and those kinds of periods that, getting big faster, partnering with a company like Forge Global made sense. We could consolidate our capital raising, establish a clearly, number one position in the market. 2, it gave me the chance and a bunch of the people that were with me at SharesPost and at NASDAQ to start something new with a different model. And I thought 12 years was long enough.
It's a good amount of time to be building a company and growing it. And you mentioned kind of why Forge Global in terms of bringing, basically effectively a merger to some degree. At that time, what in terms of the rankings of secondary transactions at the time, where was Forge and where were you guys?
Well, it's always difficult because there's no centralized place to go to see who's doing what volume. So, and people sort of famously and to this day still count their transactions in a bunch of different ways. You count buy side and sell side. You count, what transactions do you take credit for to add to your transaction volume. But I think we were roughly equal. I think we probably, in most quarters, we're doing more transactions. We had kind of had a larger sales force, a larger kind of trading desk. But certainly we were 1 and 2, and putting us together at the time made sense to kind of create a clearly dominant secondary marketplace of its type.
No, I'm very familiar with the brand, and it's been a staple in the secondary space for at least 5+ years or so, 4+ years.
Forge, yeah. Well, and Forge had started basically as a firm called Equidate, which was much more of a forwards platform. We were kind of the broker dealer doing more kind of vanilla, buyer seller transactions for commission. Equidate was more into the SPV and forward based contracts, and so there was also a product differentiation that bringing them together also made a certain amount of sense.
Nice. And when it came to that type of arrangement, was it more of a merger or was it more of an acquisition?
Well, I guess we thought of it as a merger. They may have thought of it as an acquisition, but at the end of the day, you each own a certain amount of the company, and I was on the board, until it went public by way of SPAC. But mostly, one of the things that was super important to me was where our team would be placed in the combined entity. So, we had some great people there that I think were really industry leading. So Jennifer Phillips ran our broker dealer and our trading desk. And so it was very important that she become the head of trading at Forge. And she just recently left, but she's been there for years. And that was because, one, I wanted to make sure that all the people on the team had good landings. And also I felt much more confident in the value of the shares if they were running some of the kind of key parts of the business.
Well, one thing that I think is interesting with the Forge Globe story is this perception of merger versus acquisition and how two parties might have two different definitions. I see this happen all the time where it's like equal size. Saw in the HR tech space of the transaction I was intimately involved in where ultimately got classified as a merger because they had raised more money.
Yeah.
But as far as performance and other things, we were a little bit ahead. So when it comes to just like the psychology of dealing with like having that conversation with your board, your team, and dealing with that the moment you have that offer, and you guys are collaborating towards a transaction, like what were some kind of the feelings that you were dealing with, or kind of personalities that you were dealing with in terms of getting that over the finish line?
Yeah. So, as I said, one of the key issues for us was we were coming to market to raise capital. COVID happens, market's in free fall. So one of the key considerations was could the CEO at Forge, Kelly Rodriguez, would he be able to raise the capital to fund the go forward combined entity? And that came down to the wire, right? We had a certain time period when we signed the deal before the deal closed, and during that time period, there was an obligation on their part to raise capital, and it was a question for me that was not just is there cash in the bank when this thing closes to fund the go forward operations, but a big part of the valuation that we gave them was based exactly as you said, as your example was based on their ability to raise significant capital, kind of a step up from where we'd been in the kind of A and B round to a bigger C and D round. It was, down to within maybe not hours, but within a handful of days as to when they actually did kind of cross the finish line on the promised capital raise. And that, we had board calls where we were definitely thinking about what's the alternative to this transaction if they don't raise the money. Now, I guess the good news that came out of that is that Kelly did, in the kind of 2020, 2021 timeframe, a great job of raising capital and bringing really large institutions into the company, which culminated in the SPAC that was closed. I think it was a $2 billion valuation at one point. It's since reversed itself rather dramatically. Yeah, exactly. But I mean, so fundraising was a key concern, and that was something that was a box that was just barely checked before it closed, then checked in a big way after it closed.
Yeah, no, it's tough to go through that experience, and I'm not sure what you can and cannot share in this situation, but obviously, for the audience that's not looking at Forge Global's public stock, but obviously it had a huge spike but has since recently this year done a 1 to 15 reverse stock split, and is about 1/10 or so of that kind of like peak valuation, or maybe a little bit smaller at that point. So like when you see that, you're in 2021, you sell when kind of valuations are at a higher point, especially you sell for 160 and the company is effectively worth for $2 billion down the road. Like what's going through your mind? Just dealing with that roller coaster, especially a SPAC, which obviously has its connotations, and then the aftermath of the general market collapse thereafter.
Yeah. Well, I mean, I'd been in a handful of companies, venture-backed companies that had exits in the past, and so I had seen versions maybe not quite as dramatic as the rise and fall of the stock price at Forge, but I'd seen that dynamic happen a bunch. And it wasn't a novel insight in 2020, 2021 to start to feel like the market was way out over its skis. So, I never anticipated the $2 billion valuation. I never, thought of that as the true value of the company. And so where it leads me, not that I needed more encouragement or another reason to think about founder liquidity, but just, thinking through ways to generate liquidity along the way, to put a floor under the value of your net worth, was something that was, as I said, not unique to me, but it really highlighted for me in a very personal way how important that can be, just a peace of mind and just making a smart long-term financial plan and not wanting to ride the roller coaster or be at the mercy of the roller coaster.
So that takes me, let's take a step back. So, we have the acquisition or merger, and, the IPO or SPAC and everything. But you obviously built a meaningful company. You raised around 20, plus $1 million over that 10, 12-year journey. Kind of walk us through that experience of, the early days of deciding to do this, 2009. That's when the markets have completely fallen off. Like, who's thinking about more private transactions? Granted, real estate was what blew up, but how did you come to this conclusion?
Well, yeah, so it's true. Setting it in time is kind of important because in 2009, venture, was not exactly a sleepy backwater of private equity, but it was much, much smaller than it is today. And, really, the idea came, I was looking at what was happening at Google and its IPO. And so, it just struck me as funny or strange that the founders there didn't want to go public, right? They're probably, again, sort of ancient history now, but, essentially the SEC made Google go public when it had a certain number of shareholders, because there's this, securities rule that if you have a certain number of shareholders, you got to start reporting as though you're a public company. And basically, universally, all companies, once they have to report as a public company, they say, I might as well have that benefit. But they didn't want to. And so they were looking for exceptions and looking to delay the IPO. And that just, in the kind of world I grew up in venture, almost having the IPO, ringing the bell on the New York Stock Exchange was almost the reason you formed a company. That was the victory lap. That was the end goal. And yet these guys were like, no, it's not really what we want. And so I started to think about why that might be the case. And there's a bunch of different structural changes that all kind of created this perfect storm that made me, or convinced me that these companies, this was not a one company thing, that this was going to be the dominant strategy for how venture-backed companies got built. And if that was the case, then, the employee equity strategy, which has been kind of the core of the Silicon Valley model, where you give 10, 15, 20, 25% of the company to employees as an incentive, it breaks down because, individuals, employees are not the Harvard endowment. They can't wait 20, 30 years for a return, right? They've got to put kids through school, buy a house, or start new businesses. And there's just going to be this fundamental mismatch. And so though at the time, there really wasn't a need for a marketplace to match buyers and sellers because the companies were going public when they were $300 million, $350, $400 million in valuation. If that was going to be extended significantly, you were going to need a platform because you're going to need an alternative source of liquidity.
Oh, it's amazing to have that level of hindsight and kind of see what was happening in the market that early, while everyone else is, scrambling to survive. Um, and so you make that bet, and definitely catch a tailwind because obviously you made the right bet. Private companies stay private longer, whether that's right or wrong, it's fact, and that's what we're continuing to see even to this day, continue to be. So when you were building SharesPost, like who was your customer, and how are you scaling the business?
So, rightly or wrongly, I think the strategy we pursued was one where you look for the customer that has the fewest options and the most pain, right? The least number of alternatives, and that was the smaller to mid-sized employee, right? So it had always been the case that founders and C-level executives, by virtue of having the discussions with the venture capital investors, at least they could go to their board members that represented funds and say, "Look, I've got to buy a house," and they would, some kind of deal would get cut at a kind of a one-off. But if you're a senior director of marketing or a manager in the the technology group, a coder, a developer, you really don't have that option. And so finding a place for them to connect with the buyer was where we started. And the thought being that once we got kind of initial transactions and an introduction to the company, we could kind of swim upstream and get larger and larger transactions, because it just made so much sense to us that companies would want their equity compensation, the stock options, to be really meaningful. That was the only way they could really compete with the public companies like Microsoft and Google that were paying twice the salary because they were awash in cash. So you have to make that equity comp worth something. And that was the approach that we thought they should take.
And how did you go about getting awareness? Like, were you selling directly to them to basically come join the platform? And then how are you then convincing boards or how are you creating the transaction? How are you creating the liquidity for them?
Yeah, well, it wasn't hard to source the original sellers, the employee sellers, right? So this is, they're easily identifiable on their LinkedIn or where they work or other, kind of tech centers. So we took over the Caltrain station with a sea of ads. One time, everyone coming in. That was one of our more fun events. But convincing the companies was definitely much more difficult than I thought. And so what I realized, and maybe it was clear, but particularly kind of the old guard venture capitalists, so the real traditional Sand Hill Road guys, really did not appreciate the idea of employee liquidity. And there are good reasons, and maybe, at least from the company or the employee's perspective, maybe less good reasons for that, right? So the good reasons are, does it fragment the cap table? Do you bring a bunch of retail buyers, into the company? And, the conventional wisdom is that retail buyers are more litigious. Although I'll note that in the, 12 years that I was running SharesPost, there was never, and we did 10,000 odd transactions. There was never a single lawsuit of any kind filed either against SharesPost or against any company in connection with our transaction. But there was this fear that it would happen.
Yeah. I want to stop you there. How many lawsuits did you see amongst the VCs against the companies in that time?
I hadn't done a search for that, but that would be interesting.
Probably a much higher number.
but I think the VCs, there was a circling of the wagons back then. So it was sort of a nascent marketplace, and it was a new idea. And when they looked at their interests, they said, "This is not in our interests," right? So we want to be, if not the first, among the first to get liquidity for our holdings, and we can't sell on these marketplaces. So why should they? It only disincentivizes those employees. And I think that is that's reasonable. There's logic to it. I don't think it has borne itself out. Meaning, I think the companies that manage liquidity that for their employees in either a NASDAQ tender offer or a Forge marketplace or what we're doing at Collective, I think they benefit from the retention and recruitment capability. And I think the founders recognize the need to provide that liquidity. So that old guard, that argument is, I think that ship has kind of sailed. Like it slowed the growth of the market really significantly in the first 2, 3, 4 years. But that it's like each year the market has moved 10% towards liquidity, and so now 5, 6, 7, 8 years later, there's certainly still companies that prohibit all secondary transactions and liquidity, but I think they're probably in the minority at this point.
Well, I'm curious to get your take on what I'm seeing in the marketplace of secondaries is the stacking of SPVs. And for the audience, maybe give the audience a quick understanding of what an SPV is, and then kind of what your take is on those.
I remember I drafted the first operating agreements for the first SPVs in the market. I mean, it had been a structure that had been used before, but SharesPost was one of the first to create it. But essentially what you're trying to do is solve for the mismatch in size between a buyer and a seller. Right? Meaning a seller has $1 million worth of shares they want to sell, and you have 10 buyers, but none of whom wants to spend more than $100,000 or invest more than $100,000. So you aggregate them into one entity. Creates a revenue opportunity for the platform. The companies prefer it because rather than processing 10 different transactions and getting 10 different shareholders, now they're getting one shareholder, one transaction. And I think the last I looked, they're about 40% of the market now is done in SPVs.
Well, there's also these kind of like SPVs that are set up to kind of have their own independent transactions separate. The company itself, like SpaceX, is known for this, where SpaceX does not approve primary, like actual direct secondary sales.
Yeah.
And so there's SPVs of SPVs trading SPVs.
Yeah. Shells within shells, like the dolls.
Shell of a shell.
Yeah.
So I'm kind of curious, like, do you think that is healthy for the market, or do you think that's not healthy for the market?
I think it's healthy for the people that participate in those transactions. Obviously, they're smart, knowledgeable people making the most of the opportunity that they have. But I mean, you just think about the fees within fees within fees is a challenge, and then the diligence that you have to do into each SPV is also a challenge. Meaning, I think it was a rare occurrence, but there are certainly cases where we were aware that other platforms put together SPVs. The company went public. The investors in those SPVs expected a distribution of the shares, and the manager said, well, no, actually, I continue to earn fees. If I just hold on these a little bit longer, I'll find the right time to sell when it's right for me. So, if you've got 3 layers of SPVs, you better make sure you understand the waterfall from a company exit through to cash or shares in your account.
Yeah, I find it horrific, to be honest, like, especially because the access, because everyone makes, we're closing in like a week. We got to act fast. Like, no, you can't diligence. I'm just like, when all these companies start going public, when like Stripe goes public, SpaceX go public, how many people are going to be left holding a bag of like nothing?
Yeah.
That was just like a shell that sounded like they were actually going to own the, entity and then not.
Yeah. Well, and it's very, you need a good lawyer to do the diligence because the operating agreements are complex documents. It also, you've got to kind of ladder it all the way back up to the company's, bylaws and provisions and what they'll allow. And, it can be a challenge. So it's, certainly layers of, at a minimum, bureaucracy and potentially worse.
Yeah. I could tell there's definitely some situations where I'm quite confident that there are people running these SPVs with malintent, and it's unfortunate with whether they actually own the entity or not, but also the fee stacking on top. It's like, okay, you're getting into a 2 and 20 vehicle. We're going to charge a 7% entry fee into that vehicle, and then we're going to charge 2 and 20 on top of it. I'm like, how do you make money?
Yeah, right. Yeah, no, it's fair question.
So with okay, going back, one deal we talked about before we kind of got on the record here that I thought was really interesting about your story and about your background was what you did with NASDAQ. You were explaining to me that you did a joint venture with them. Kind of walk us through how that came to be and ultimately how you walked away with $15 million.
Well, not personally, but yeah.
Well, fair enough.
Right. And that's just an estimate, but yeah, that was in that neighborhood. So, yeah, so I think the time frame I want to say is sort of 2011, something like that. So we founded SharesPost in 2009 when they're just a handful of companies, so LinkedIn, Facebook, and actually it's funny. So we called Facebook a unicorn. I think most people have kind of forgotten now where that word came from, and it was because it was such an exception. It was such a rare animal in the jungle, forest, wherever. That we call the unicorn. So there's just a handful of them. But then, the next year, so it starts with 4 or 5, then it becomes 12 or 15, and then it's now 25 or 30. So, and the dynamic of the market, why companies were staying private longer, was becoming clear. And Bob Greifeld was the CEO at the time at NASDAQ, and recognized that where this market could go, and the impact it could have on the public markets, which was at the time, the majority of NASDAQ's revenue, the listing fees, although it was starting to kind of slowly shift to other products in the NASDAQ, empire. But he knew, or they knew pretty quickly, that they really didn't have the expertise in venture capital, Sand Hill Road, secondary markets of pre-IPO shares. And because the public equities markets, the way they trade is just radically different. It almost has nothing to do with how private markets trade or venture-backed companies trade. And so they wanted to kind of lean on us for expertise. So we did a 50-50 joint venture with them. They contributed their brand, they contributed capital, we contributed basically team members. And so I was the initial president, I think was my title, of NASDAQ Private Market. And I got the regulatory approvals to set up an alternative trading system, designed the first tender offers, built the technology, ran the first programs. And so, it was an entry point for them. I think it worked well from their perspective. Obviously, NASDAQ Private Market has become the central provider of tender offer programs, which is one of the variants by which these companies provide liquidity. And they kind of had pole position to that space. And then they later bought Second Market, which was the only other company kind of doing similar sorts of things. So, but about 2 years after we started it, I didn't really have much of a desire to work in a large company. Wasn't really a good fit in terms of, call it, corporate culture or my temperament. So I was, looking to kind of step back, feeling I'd kind of done what I signed up to do. And just so that they could, because their brand was on it, they really wanted to own and control it, which made sense. So we sold it back to them. And again, my best recollection is I think the total consideration was $15 million paid to SharesPost, which then allowed us to fund the continued growth of our company without having to dilute shareholders with another financing at the time.
So that's what I want to kind of talk about and educate our audience about. Was this opportunity came about, most founders think about an enterprise type proof of concept to collaborate or work on something, but you designed this joint venture structure that then paid a substantial dividend in the end that probably would have been way more than what they would have paid you in any kind of enterprise contract or anything of that sort to go out and build it for them. When you came to architecting that deal, what would be some of the things that were that you can kind of take away and share with our audience that might be applicable to them for their consideration?
Well, when you say that deal, do you mean the sale back to NASDAQ of the company?
No, more so just how you set it up, how you chose the joint venture structure.
Well, so my background is I started my career as a securities lawyer at Wilson Sonsini, which I'm guessing, given your audience, almost everyone's going to know who they are. But that was a great way to kind of break into the Valley. And I had the good fortune to work with a guy named Marty Corman, who ran their M&A department and really kind of trained me in, among other things, joint ventures. And the reality of joint ventures is they rarely work, right? It's very challenging to align incentives, certainly over the long term. And so I was hesitant. We didn't want to sell SharesPost, but we wanted to basically have NASDAQ's capital and brand, right? This is another real and significant incentive for us was the companies and venture capital firms were on the fence, and many of them were really resistant to the development of the secondary market. And so, we looked like, the Wild West, of, kind of online broker dealers never been seen before. There were all kinds of worries about, what our regulatory, profile was, what our compliance program was. And so by bringing NASDAQ in, we don't only legitimize SharesPost, we legitimize the market as a whole, or at least that was the strategy. So that was kind of our motivation. And then just in structuring it, you of course, you want to have an exit in mind. Like, how is this, assuming you're not going to stay married in a perpetual joint venture structure for 50 years, what happens if you're successful? And so thinking through what that mechanism looks like is super important. And there's, it's again, not any great insight there's earnouts and things that are tied to revenue and performance that makes NASDAQ feel more comfortable. I guess one of the things that I really, didn't take into account that if I had to do over again, or at least I would consider, was just the clash of corporate culture, right? So just all of the cliches about the challenges big companies have mixing with little startups. I mean, they're cliches for a reason. They're cliches because they're
true.
Yeah, overwhelmingly true. And that was the case. So, and it kind of manifested itself in everything from how we marketed the company to how we built the technology, and obviously the strategic direction of the company and the incentive. So, I mean, NASDAQ, was pursuing this joint venture because they wanted to dip a toe and be kind of first to market amongst the major exchanges, the London Stock Exchange, the New York Stock Exchange. But they certainly didn't want to put their public market listing business in any kind of jeopardy, because that was the main revenue stream for the company. And so they were never going to risk losing a potential listing because we did a transaction on NASDAQ private market. So they were very cautious and very hesitant. And so that was why it was really, I think, good for them, good for us to, for me to exit, for them to take over with their culture, their strategy. We did, I think it did legitimize the market a fair amount, or more than, it moved the needle somewhat, and provided us funding. So I would have taken a different approach to building that business, NASDAQ private market, than they did. And there were a bunch of things that we suggested that they do that they didn't do, which I think they would have, I wish maybe now that they had. But all in all, it was a important milestone and a success.
Well, it's interesting to have that kicker in the end where this is not just terminating a contract. There's equity has to be bought back.
Yeah.
There's a deal that has to be struck and made. And just a clarifying point for my sake, was SharesPost still operating 100% independently?
Yeah.
And had no material value. It was basically the company, like, we're bringing this together in a completely separate joint venture. So it wasn't like they kind of merged you in and then bought you out.
Yeah,
so you had that independence.
Yeah. Well, and that was important as well, because I think SharesPost at the time was a significant percentage of the trading volume, which is a fraction of what it is today. And so it was in both the interests of SharesPost and NASDAQ for those entities to continue, so that SharesPost could bring its transactions to the NASDAQ private market and bring that volume and that activity and those buyers and sellers and company relationships. Whereas if we combine them all into one, you'd have a trading platform without a sales force.
Real quick, if you're a founder doing over $5 million in revenue and want to know what the best $100 million plus founders are doing to fuel their growth, then make sure to subscribe to our $100 million exits newsletter. Get the playbooks that are proven on how to fund, grow, and sell your business. I'll even give you a curated list of investors that want to invest in your business. It's totally free. All you have to do is click that link down below. Subscribe, do it now. I promise it's worth it. You won't regret it. You got nothing to lose. Go ahead, subscribe now. Back to the show. So, yeah, I love this story, and I think it's great that you're able to share this, just because I don't hear a lot of joint venture structures with corporate and how these kind of materialize. So, obviously, there's pros and cons, but I think it's another feather in the cap to think about, or another idea to think about as people go into doing deals. I want to take a step forward into SharesPost. Kind of before you sold, just walk us through a moment that you felt that things were working, things were going in the right direction, and that you made some bets that hit.
Yeah.
What were some of the bets that you made that hit?
Well, yeah. So I'm trying to remember exactly the time frame. I think it's sort of 2019, early 2020. It just, a bunch of things were going right. Like we made enough mistakes and had enough time pass that we'd learned from them and fixed some things. As simple as website training, rebuilding the technology platform, making it a lot easier for people to transact. And we invested in building out a sales team. And so we were seeing revenue start to ramp pretty materially, and getting just right on the edge of profitability. And so it was, as that was happening, we're thinking about, okay, we're going to wait till we break even, and we get revenue to whatever kind of new threshold we were looking at the time, and then we'll go do the next round of preferred financing, because we felt like, we would find a VC or some handful of VCs that were willing to kind of support the idea of a more liquid secondary market for venture-backed companies. And so I think it was, just the investment in our growth. But then, like we just hit the wall when COVID happens, I think kind of late 2019, 2020. And in Q2, the markets are in free fall. And so because we had delayed our financing, we're all of a sudden feeling like we don't have as much, as the kind of comfortable runway we would otherwise want, particularly if we're now looking at a 50% decline in revenue in Q2 of 2020. And so, when it hits the fan, that's when you start to think about maybe, finding, a merger partner or an exit opportunity. But I mean, I guess the good news was we had built this sort of market leadership position and a brand that made us an attractive partner for, basically a partner that could bring the capital that we didn't have at the time.
No, it's an amazing story to kind of have that self-reflection. Like, you're hot, everything's going up and to the right, everything's going well. You delay a little bit while you can and maximize valuation. I hear that story all the time with founders, and it's tough to decide. Take it when it's hot, and take it early, and just forego the dilution that you might have had. To create that optionality.
It's much more important to close a financing than to close the financing at the valuation that you dreamed you were going to have at that point, right? I mean, it's a binary outcome. It's, if you raise the money, the company's on to the next round, or the next stage. And if you it doesn't matter whether you raise it at a $200 million or $220 million or $300 million valuation. It's the capital you need to grow.
Take it when it's on the table on fair terms. I can't tell you how frustrating it is for me in my position. I work with founders every day on capital and M&A, and like, we're gonna wait. We're gonna keep going. Like, we don't love these valuations. It's like, well, the market just isn't giving you those valuations anymore.
Right. Well, and there's a reason, right? Yeah, the markets are smarter than most individuals. So.
Yeah, and I can't tell you how many times where I've seen it where they're like, oh, we didn't raise the money. Like, no, now we're scrambling, and now you're a desperate case. Now you're not hot. Now there's fewer terms. Now the valuation's even worse.
Yeah.
And there's always a time and moment where everything's going well, where every VC is looking at you and being like, oh, we should do this deal. And I see founders like, no, we're gonna wait, and then all it takes is 1 month of plateau or worse, and all those term sheets that would have been are no longer. So definitely empathize there. So you end up selling for 160 million. Congratulations. And Forge goes public. Obviously quite the turmoil which we discussed. But most people would hang up their hat, go sit on a beach, think about, fun activities with family or whatever, but you decide to go back at it.
Yeah.
Slightly different approach, but, similar market. Tell us a little bit about Collective.
Yeah. So I think, part of the reason for the merger or sale of the company was COVID and capital raising, but part of it was also, I think, for me, a recognition that I'd spent, again, more than a decade building that company. So I kind of felt like everything I had to give to that business, every idea I had that fit within a broker-dealer kind of platform or alternative trading system I had given. And it still, it still didn't feel like it solved the problem, basically. And you could look at this from a bunch of different angles, right? So if you think, I don't know what the latest estimate is of percentage of the market that turns over, but if you're looking at, say, $3 or $4 trillion worth of aggregate market cap, and you've got only maybe 100 billion, that's just a number I'm just making up right now, that is trading on the secondary platforms, is still such a tiny fraction. So there's something that's clearly not working, and even anecdotally, like we all know founders that are in really attractive companies backed by the highest quality VCs, but just still can't find liquidity for their shares. And this is sort of an age-old problem, right? I mean, back to like when I started my career, even a decade before SharesPost, I've been around venture-backed companies and just seen the challenges that employees and founders had, given that they had to go years waiting to see whether their shares are going to be worth something and have it be kind of a binary outcome. And so I thought what would be really useful and different and a successful business would be an alternative to selling the shares that would be accepted by companies that acted, and this is was me on my soapbox. This is a little bit, I don't know, philosophical, and what our customers care about is something much more tangible, which we can talk about. But is basically a utility that sits within the middle of the venture ecosystem, where those that have too much risk, principally the employees, can lay off that risk in return for liquidity and diversification, so they can create a floor under their net worth and create a really sensible long-term financial plan, and a way for those that didn't have access, maybe they couldn't write a $50 million check to Sequoia, or otherwise couldn't find a point of entry, could take more risk. So, there's just a clearinghouse of, access and risk. And so that's really the highest level desire that we had in thinking about Collective. And then we found this vehicle called an exchange fund that had been around in the public markets for a long, long time, but had never been poured into the private market. And that became kind of the linchpin and the key to what we do today.
Yeah. So walk us through that. How does that work?
Well, first, I'll just tell you what an exchange fund is, because it's if you're not a public company person that has a good financial advisor, you might not know. But they've been around since the 1960s, and essentially what they allow you to do is to take an appreciated position in a stock, and most likely an over-concentrated position that you want to diversify out of. You want to reallocate. Maybe you bought Apple 10 years ago, and now it's worth 10 times what you paid for it, and you're overweight in Apple from where it is today, so you want to get out, and the natural choice would be just sell your Apple shares and then take the cash proceeds and reinvest. But the problem is you pay tax. And so the exchange fund allows you to take those, say $100 worth of Apple shares and exchange it for $100 interest in a diversified fund without triggering capital gains. And and so I think Eaton Vance was bought by Morgan Stanley, but they're the largest kind of best known manager of these kinds of funds. They manage $500 billion, or that's the consolidated basis they report, is their AUM. So it just, it's been around that long, decades, and it's grown that large. There's something there. And it just seemed to us like, if it makes sense for a public company executive, it makes even more sense for a unicorn founder, right? Because typically they're even more over-concentrated. The bulk of their net worth is tied up in their company. And they've had even greater appreciation in the value of the shares. So they've gone from $0 to $1 billion valuation. And so the ability to do that trade or to diversify without paying tax on that appreciation is even greater. But it hadn't been done before. So there's a bunch of legal and tax and other issues that we had to solve in launching it. But once you've done that, you now have the sort of alchemy that can exist that benefits all the parties in the market, which is I take a single position, I exchange a $100 position in my unicorn, I get a $100 LP interest in a diversified fund. I can do things with a diversified fund, or I can make a plan based on a diversified fund in a way that I can if I'm on the roller coaster that is a single stock. I can borrow against it. I can sell the interest back. I could contribute the LP interest into a donor advised fund. I could contribute it into a charitable remainder trust. It becomes a security or an asset that is usable in many different kind of traditional wealth management contexts in a way that a single concentrated position in a private illiquid stock is not.
So just for taking a quick overview explanation here. So if I am, I'm the CMO, but not the founder of a company, I maybe got 1% of the company at its like Series A or something, or seed. And now it's worth maybe like $5 million, dollars. That's what that 1% of that I got would, be worth hypothetically at the last valuation. So to give myself, as you speak, a floor. So it's like, hey, $5 million is awesome. That would be life-changing money for most people. But you can't do anything with it. You're maybe still not getting paid full market salary or whatever. And you just want to take a little edge off, but you still do it in the company. So maybe you
20% of your shares,
like $1 million.
Yeah, exactly.
So where does that million? So what am I putting that $1 million into? So now I've lost my interest in. I've lost that $1 million interest in my company in exchange for what vehicle? So I know the vehicle. What was it going into?
So and there was just one point of clarification. So you take that $1 million worth of shares in your company, you exchange it for $1 million LP interest in the fund. Other founders similarly situated are doing the same thing. So it's basically, hence the name Collective, right? It's a collective of founders and tech executives from the best companies. And so that is one, call it limitation. It's a strength and a limitation of our model, right? So in order for you to be excited about exchanging your $1 million with a company you believe in for $1 million LP interest, you have to have a lot of confidence that the fund that you're exchanging into is of the highest quality. And it's hard, if we're looking ultimately to have 100 companies in the portfolio, it's hard to do that at a seed or Series A or Series B stage. So we need to filter the companies that are eligible for exchange into the fund. And it's really, of all the different things that we do, we answer that question, we solve that problem in the most traditional way. We have a bunch of super smart, super experienced, super successful venture capitalists and investors that sit on an investment community or committee and say, if looking at the portfolios of Andreessen, Sequoia, Benchmark, Excel, basically all the kind of famous VCs that are enormously respected for good reason, we look at their portfolio and we pick just the winners from those companies and we make those eligible for exchange, because that gives a founder confidence not necessarily in our investment decision making, but they believe in Sequoia and Andreessen and others. And so that one of the first and maybe the biggest problem that you need to solve as an exchange fund is the adverse selection problem. If we didn't have that requirement, if we didn't have that filter of making, defining companies that are eligible and by implication those that are not, you would say any crappy company comes to this fund, trades the shares. These guys earn management fees off of whatever comes in, and yet nonetheless, ultimately I have to get liquidity for my interest. If there's a bunch of crappy company, nothing's ever going to materialize.
So I guess let me take a step back here. So I'm exchanging I'm in ABC Co. Or 500 million backed by the best. My stock's worth $5 million, whatever. Now I'm giving my $1 million value and purchasing an LP interest amongst similar private companies. So it's all still private. So do I get $1 million cash, or is that like a service you add on top of that in terms of like maybe you lend against 50% of the portfolio value or things of that sort?
Exactly. So about anywhere from 30% to 40% of our customers do just the exchange, just for the diversification, just to de-risk their position. And they're happy. I mean, essentially they're taking $100 worth of company ABC, putting into a fund, tax deferred or tax free effectively, and are, have good reason to expect that $100 interest is going to appreciate at long-term venture capital rates over the next 6, 5, 7, 10 years, whatever their investment horizon is. And that's, that's something we feel great about. That's a really solid, that's a real significant benefit to that customer. So, peace of mind, diversifying their assets, creating an investment program outside of a single company makes all the sense in the world. But 2/3 roughly of the company, of the employee shareholders and founders that come to us are like, but I also need cash, and I need cash today. So what we have done is work with a variety of different partners to create different forms of liquidity, and it's not really a sort of one size fits all. So the program we started with was with WebBank, and that was a program where they'd lend at a 60% loan to value ratio. So I got $100 of ABC, traded for $100 LP interest in the fund. I can then take $60 out in a non-recourse loan at a no stock fee at a relatively low interest rate. So that was a remarkable program. We've exhausted the capital in that program, and so we're now talking to other banks. And so, we think of it as our job is to continually be in the capital markets on behalf of our LPs, sourcing the best financing available. So we're partnering with banks that offer basically lower LTVs now, but at a lower cost of capital, but they're recourse loans. We partnered with a private credit fund that provides a higher LTV, non-recourse, but it's more expensive capital. And those programs are going to come and go as we exhaust them. Maybe we'll find the perfect partner that allows us to scale to hundreds of millions of dollars. But right now, we're basically offering two flavors of liquidity: lower LTV, lower costs; higher LTV, higher cost.
That makes sense, and gives people the flexibility of what's priority for them in that moment.
Exactly. How much liquidity do they need? Yes.
Yeah. And also, things I always have to point out for people, it's like, oh, I don't want to pay 10% interest or whatever. But you would pay 15 to 25% cap gains if you were to have the right to sell. Just taken off right from the top. So,
well, and most people don't have it as their time in their day, given they have a day job, to like be talking to 10 different credit funds, 3 different banks, 4 different. So that's what we do.
And they won't get underwritten anyways. It'd be impossible for them to be underwritten.
And if we, by consolidating a group of founders and clients that everybody wants, if we can't get you a lower cost of capital, because we make essentially nothing on it, we just kind of pass through the equity, or in some cases with some banks, we just hand them directly to the bank. And we're not even part of the transaction. If we can't find you a lower cost of capital, it's because it doesn't exist. And it's because even though you're super confident in your company ABC, an investor might have more caution.
100%. I think that's the reality. And it's good that people are blind by their passion for what they're building and think it's the greatest thing ever. But credit's a different game, the venture, and it's underwritten very differently, and pricing is very different. But it's great that something like this exists to give optionality to those that were fortunate enough to get employed by some of the best companies in the world.
Yeah.
But then are stuck with that burden, because especially if you're in the Valley. It's just cost of living is astronomical. Like 3-bedroom, 2-bath house is like $3-4 million.
Yeah, no. Let me tell you, just my PG&E bill is now like $1,500 a month. So yeah, I need an option package just to pay my utility bill.
Cost of living. That's a whole other rabbit hole we don't really cover on this podcast in terms of cost of living. But I think for the audience here today, what would be one thing that you want to share with them about your background, about your experience, that you think would be applicable to, a founder that's doing a couple million in revenue, thinking about, what's next?
Yeah. Well, I've made enough mistakes in my life that I got many lessons to share. I guess I'm trying to look at it from a positive perspective. But I guess, actually, Jason, you and I were talking about it a little bit before the show started. I think particularly with young founders that there's so much attention paid to the venture capital approach to building a company. And it's, it can work fabulously well, and everyone focuses on the success stories for good reason, right? So meteoric growth is not a problem. And then there's an enormous public exit, and, people are making $50, $100 million or more. But just I've heard it compared to kind of being put on a treadmill. Right. When you do that venture financing and you're kind of handcuffed to the front of the venture, because once you take that venture money, you are a venture capital company, right? So the certificate of incorporation, your board structure, the control provisions that come with the venture financing appropriately, because it's high risk capital, and the venture capitalists need to make sure that they get a return for their investors. So they're putting their protections and safeguards, but it ties you to that treadmill. And if you do a Series A, if you don't break even, you better be able to do a Series B. And so there's a certain amount of growth that needs to happen between and then the B and the C. And you're kind of, it's like you kind of have to run the table in order for that to be a really successful outcome. And but by running the table, I'm meaning you can make one mistake, probably not 2. You can have, 1, down quarter, 2 down quarters. But if you lose momentum, then things like the liquidation preferences that you locked in up front, and if you have to do a down round, the dilution, anti-dilution protection that kicks in, it's not pleasant, and you can lose a lot of value for the common holders, which are typically the founder and the employees that you thought you had built. And so, I'll just talk about the way we're managing Collective, having done this a couple of times and had the benefit of, a little bit of liquidity along the way. I've found a couple of great partners that have invested alongside, not large amounts of money. We're still we're kind of beyond the proof of concept, but we're kind of pre-scale or on the edge of scale. So hopefully, we'll be, this question of can we do a venture financing will be relevant to us, next year, or something we'll consider. But there is an alternate route, which is raising not venture money in a more traditional kind of, non-preferred stock kind of basis, which is, it's traditional private company, the ways like sole proprietorships have been built, and it's using debt that is available to you as an alternative to the venture approach. So just don't be locked into I'm going to be Google or Facebook or whatever the company. Maybe SpaceX is a better way to look at it. Given the opportunity, and it also typically, if you're a founder, one of the things that you think about is how long am I going to be able to control the direction of the company, and certainly venture financing for most founders, not for Elon, but for most founders, is you're starting a clock on how long you're going to be basically unilaterally dictating the direction of a company, because ultimately you give up board seats, you give up controls, and you find that you're not in the driver's seat in the way that you thought you should be.
Well, you're preaching to the choir here, because this is what I do every day, is help founders realize that there are other paths than venture. And what's hard for, I think, a lot of founders to realize is, sure, they might have raised a seed, a Series A, maybe even a Series B, but like you said, like there's certain expectations that come with that. And if you're off the momentum train, and or you could be doing everything perfect, but your market falls out of favor. Like if you're an ARVR a couple years ago.
COVID happened. Yeah. Zombie plague.
Yeah. And so many things can just derail that are out of your control. And that's also why, I want to just kind of wrap us up going back to this, create your floor. Like I see so many founders that are putting everything on the line. They have nothing to give them any kind of support or, cushion. And albeit that might be the right motivation for some, it's definitely not for most. And I designed my, founder history and career pattern to like get to a floor as fast as possible. Like when I built and sold, Walmart, Liquid Sky to Walmart, it was the intent to sell in as short a period of time as possible to kind of create that floor. And I think more and more founders need to think about having that floor, because it just gives you a different type of mindset to build and scale a company in a very different way than maybe if you're in a state where I need to get a 6-figure salary right away. Otherwise, I can only do this for 3 months, 6 months, a year.
Right.
Yeah. That's very different mindset to build a company in.
Well, and it can allow you to take risk, right? Meaning if if there's no liquidity along the way, and you get your first acquisition offer, and you may feel like you're compelled to take it, but if you've taken enough off the table in the interim or previously, you can say, no, I can go another 2 years, 3 years, and bring these new ideas to the business that no one's had a chance to see yet. But it's the ability to manage your risk or choose your risk. I mean, for most founders, like if you were to ask them, if you step back and you're not an employee, you're not connected to this company, would you invest all your money in this company, no matter how promising? Would you invest all your money in a single company? And nobody in their right mind would say yes. Yeah, just
unless
because. Yeah, well.
Well, in all fairness, he's got like 10 now.
Yeah, so, exactly. But it gives you certain freedom to choose your path. That the absence of liquidity creates desperation under difficult circumstances. It's the unknown unknowns that can occur. New technology, competitors, COVID, all kinds of things can disrupt the golden path you thought you were on, and then it's too late.
Yeah. Well, Greg, it's been an absolute pleasure to have you on the show today. Yeah. What would be the best way for founders to learn more about Collective or learn more about you? Well,
thank you. Just come to the Collective Liquidity website. Hopefully, we just launched a new website today. We're pretty pleased with it. But hopefully, it's got good information on there. Can kick off a conversation. And I'm always happy. And anybody in your audience, I'm happy to talk to directly. So put a call in or leave us an email. There's all kinds of ways, obviously, on the website to connect with us.
Perfect. So if you're listening and you stayed this whole time, awesome. If you want to talk to Greg, just leave a comment down below, and I'll reach out to you to set up an intro to Greg. Greg, thank you again. Look forward to getting this out to our audience.
Thanks, Jason. Cheers.
If you were inspired by today's episode, then go ahead, watch this next episode. Promise it's worth it. And if you really enjoyed this last episode and you want to connect with the guest I had on today, make sure to leave a comment down below telling me why you would like an intro to this guest, and I'll make it happen.